Welcome to another explainer. Today, we're diving straight into the deep end, decoding the incredibly complex and honestly highly misunderstood architecture of US taxation for global remote workers. We're cutting through the noise and focusing purely on the mechanics, the hidden tripwires and the cause and effect relationships that actually trigger international tax liabilities. If you run a digital business from abroad and touch the US market in any way, you absolutely cannot afford to ignore these non-obvious details. Let's get right into it. Just to grasp the sheer macro-level scale of what we're dealing with, think about this. Compliance analysts track roughly 80,000 distinct tax jurisdictions worldwide. 80,000. When you sell into the US, you're not just dealing with one big federal umbrella. You're navigating a massive, fragmented maze of state, county, city, and even hyper-local district taxes. So right off the bat, we can completely toss out the idea of a one-size-fits-all compliance strategy. It's mathematically impossible. And what makes the system so volatile isn't just the size, it's the speed. Expert reports show there can be up to 3,000 sales tax law changes in the US in a single year. To put that into perspective, that's roughly 10 rule changes happening every single day. We're not just talking about a rate bumping up a fraction of a percent, we're talking about fundamental shifts in what is even considered taxable. Unless your hobby is reading tax code all night, your operations absolutely have to be built for relentless adaptability. So today, we're going to filter down this macro-level chaos into actionable mechanics. We'll cover 1. The US tax labyrinth. 2. Mechanisms of tax nexus. 3. Strategic entity structuring. 4. Income sourcing and ECI. 5. Reporting versus paying taxes. And finally, 6. The cost of non-compliance. Let's kick things off with Section 1, the US tax labyrinth, and really look at that foundational volatility. The defining feature of this labyrinth is hyper-localization. Look at this insight from the report. 2 neighbors living just a few yards apart might end up paying completely different taxes for the exact same digital product. It's crazy, right? A huge and super dangerous implicit assumption is that if you sell to someone in New York State, you just charge one flat New York tax. Actually, scratch that. It's completely false. The exact street address determines the jurisdiction. The whole system is built around these invisible boundaries that dictate massive operational complexity. Which naturally brings us to Section 2, Mechanisms of Tax Nexus. What actually triggers the liability? The absolute most crucial concept you have to master here is Nexus. Think of Nexus as an invisible tripwire. The second your remote business connects with a local US jurisdiction in a specific way, you trip the wire. Bam! You now have an official, legally binding relationship with that state, and you are on the hook to collect and remit their sales taxes. Knowing exactly where these tripwires are hidden is literally the bedrock of your global compliance. Now, we really need to separate the 2 types of nexus because the mechanics are entirely different. Physical nexus is pretty obvious, right? It's triggered by tangible stuff, leasing a warehouse, having an office, or even just flying an employee out to a local trade show. But economic nexus, that's the non-obvious reality. This mechanism means you can trigger a legally binding tax liability from thousands of miles away, entirely remotely, simply by hitting a specific sales volume or dollar amount in that state. You literally never have to touch US soil to trigger it. So let's analyze the big question. If you're sitting in, say, Europe or the Middle East, and you sell digital services or software subscriptions to a client out in California or Wyoming, do you owe taxes there? The answer is a hard yes. The mechanism of economic nexus targets the location of the buyer, period. Selling digital services into a specific US state triggers local tax liabilities in that jurisdiction, totally regardless of where you, the founder, are sitting. Your remote digital sales are quietly generating active tax exposure way before you ever even think about setting up a formal American branch. Let's move on to Section 3, Strategic Entity Structuring, and examine how global founders try to navigate this fragmented system. So a lot of international founders try to use structural arbitrage. They look at states like Delaware and Wyoming, which are famous domestic tax havens for non-residents because they don't have state income tax. Delaware doesn't even have state sales tax. On paper, it looks incredibly frictionless. But assuming these entities are a cost-free magic bullet is a massive analytical error. Notice that annual franchise tax requirement? No matter which haven you pick, both strictly require you to pay this to maintain your legal status. Setting up the legal architecture is just step 1. Maintaining it is step 2. And frankly, that's where most remote founders drop the ball. Operating a U.S. entity from abroad demands strict, ongoing compliance. We're talking core maintenance, annual federal tax reporting, annual state franchise taxes, which, by the way, is basically a mandatory subscription fee just for the right to exist as a company, and renewing your registered agent. If you neglect these unglamorous little tasks, your legal protections dissolve, and you're suddenly exposed to personal liability. Not good. Okay, let's transition to Section 4, Income Sourcing and ECI. This is easily one of the most misunderstood areas of the entire tax architecture. Here is a categorical distinction that can absolutely save your business. You have to understand the hard line between effectively connected income, or ECI, and non-connected income. ECI is revenue generated specifically because you have physical operations, employees, or offices inside the U.S. If you have ECI, you are paying U.S. income tax. But if your team and operations stay entirely outside the country, you generally do not have ECI. This acts as a massive legal shield. It protects you from local U.S. income taxes because you aren't drawing on U.S. local resources to run your business. To understand exactly why this shield holds up, we need to look at the statutory framework known as the tax home. The U.S. basically sources personal service income based on where the labor is physically done, not where the client is located. Your tax home is your main place of business. So if you're writing code or consulting from a cafe in Asia or Europe, that income is legally sourced to your foreign jurisdiction. It's completely shielded from U.S. income tax, even if the client paying the invoice is sitting in a skyscraper in Manhattan. The tax liability follows the sweat of your brow, not the origin of the funds. That precise legal distinction perfectly sets up Section 5, understanding the vast operational difference between reporting versus paying taxes. There is a massive, incredibly common implicit assumption among foreign founders that goes like this. Well, I owe 0 taxes, so I don't need to file any paperwork. Analytically speaking, that is a catastrophic error. Operating without effectively connected income in the U.S. still requires you to file an informational return. You aren't writing a check for an income tax payment, but the burden of proof is entirely on you. You have to formally, legally prove your exemption to the federal government. These informational returns are essentially the structural architecture of your compliance. Think about it from the government's perspective. The IRS doesn't want hundreds of thousands of foreign-owned entities operating like ghosts in their financial system. These mandates tell the government exactly what types of transactions you're doing. They don't automatically trigger a tax bill, and crucially, they are required even if your revenue for the entire year is literally 0. Filing these is mandatory to maintain your corporate entity status and to avoid absolutely massive automated penalties. And speaking of penalties, let's dive into our final section, analyzing the very severe financial reality awaiting those who ignore all this. Section 6, the cost of non-compliance. This data point perfectly exposes the true stakes of the game. Expert analyses bluntly warn that the cost of non-compliance in the US can be anywhere from 3 to 10 times the cost of just doing it right in the first place. Think about that multiplier. Failing to understand your economic nexus tripwires, or ignoring your reporting duties because you assumed 0 tax means 0 paperwork, will cost you magnitudes more in legal penalties and back taxes than just setting up the proper architecture from day one. In this labyrinth, ignorance is absolutely not a legal defense.
Which leaves us with this final provocative question to evaluate. Are your current remote digital sales already triggering an invisible U.S. tax liability? Based on the economic nexus thresholds of your global clients, are you operating entirely in the dark right now? It is highly recommended to review your operations through this analytical lens, secure your compliance architecture, and make sure you aren't unknowingly tripping wires from thousands of miles away. Thanks for joining me on this deep dive, and I'll catch you on the next explainer.